interested than the ones that you normally do. So I'll be watching the question panel, and we may have questions for you as we go along, if that's okay.
Okay.
But if you'd like to go ahead, you have control of the slides, so let's go ahead and get started. Thank you for being with us tonight.
Okay, well, thank you all for listening, and I hope that we all learned something from tonight. I've certainly enjoyed putting this together, and always learn something new myself. Tonight we're talking about where is the inflation. If you follow closely the news, you'll see that there is considerable concern on a variety of fronts about inflation coming, but yet on a day-to-day basis, it doesn't seem to be apparent. When you go to the grocery store, when you fill up your gas tank, nothing really seems to be too different. So is it Chicken Little that's crying that the sky is falling, or is it really coming? In some areas, it seems like it's actually just the opposite is taking place. Why isn't inflation evident? You see all these foreclosed houses taking place all over the United States, probably even in your own neighborhood. We actually are seeing deflation when it comes to one of the nation's most important assets, real estate. So this really is a confusing situation. How can we be having deflation in real estate while we're projecting hyperinflation at the same time? It's not confusing if you understand recent history. How many of you tonight remember the S&L crisis of the 1980s? That was a big problem where commercial real estate had been so over-leveraged, so over-financed, that it busted our S&L system. Some of you younger people may not even know what an S&L is, so perhaps I need to explain that. We used to have two types of lending institutions in America. One were called national banks, the other were called savings and loans. The savings and loans don't exist anymore. They went bust in the 1980s. Now, what caused that to happen is something that is very important to understand as it relates to what is presently taking place. The background of the S&L bust had to do with easy money. Banks or S&Ls were loaning out money to developers. Almost anybody who put on a hat saying I'm a real estate developer could qualify for financing, and not just 30% down financing, but 100 to 125% financing. So the developer was not only putting nothing down on his project, he was frequently walking away from the table with money. So this encouraged projects to be developed that had no point being developed. I remember driving through Midland, Texas once and watching a bulldozer tearing down brand new, year-old townhouses that had been so overbuilt that the government that had taken them over from the S&L bust decided it was better to bulldoze them to try to bolster the remaining stock in the market rather than just keep them there and rent them at such low levels that it kept the rest of the market down. Mind-boggling. I'll never forget that sight blazing in my mind as we were driving around watching the bulldozers. So a poignant story I recall was looking at an office building in Boca Raton, Florida, that had been built at a cost of $6 million, that the Resolution Trust Company, the Resolution Trust Corporation had been formed. I'm stepping ahead of myself for a second. The S&L crisis was resolved by the government forming a corporation called the Resolution Trust Corporation to buy all these failed assets from the heavy lending that the S&Ls had done, and now the government owned all these properties. So the government turned around and blew out all these properties that it had acquired for pennies on the dollar. Such an example was I looked at an office building in Boca Raton, Florida. The original cost to build it was $6 million, and it was for sale through the RTC for $1.5 million. It was a 20,000 square foot building, and I should have bought it, but I chickened out and didn't. Well, today that building is worth over $10 million. So what happened was that we had a three-step situation. Easy money that was too easy, chasing projects that shouldn't have been built. As a result, there was an overbuilding, over-leveraged market of real estate in the nation in the 80s. Second step, the banks go bust, the government bails them out. Third step, the government then blows all this property out of pennies on the dollar, and what happens? The market rebounds and the whole cycle starts over again. Well, today, in the late 2000s, we've had the exact same thing happen, only with residential property. How many of you remember the late night TV ads for borrow through, I think it was called Ditech, borrow up to 125% of the value of your house? I remember watching these things thinking, who was stupid enough to go loan 125% of the value of the house? That's just inviting default. Well, sure enough, that's exactly what happened. So as a result, we had too much money being made available to buy property that shouldn't have been bought, that created an artificial bubble. The next step, the government steps in to bail out the banks, which has just happened over the past couple of years. And then the step that we're now in is the banks blowing out bundles of these properties for cents on the dollar to get their books cleared. So what's the next step? Well, the next step is going to be rebound in the marketplace. So the reason why we're seeing deflationary pressure in real estate has nothing to do with the big picture. It has to do with simply an artificial bubble that was created by easy money. The marketplace will correct this situation, and within a relatively short period of time, we'll be back to the normal strong market for real estate again. Now, let's discuss the history of United States money. The first ever hyperinflation. How many of you know that the United States has already had hyperinflation? I bet the answer is nobody knew this. It's a very interesting fact of history, but the United States has had hyperinflation before. You're looking at an actual United States currency from 1778, 2 years after our nation was formed, and this $20 says this bill entitles the bearer to receive 20 Spanish dollars, because that was the only coin at the time. There were no U.S. coins at the time, only foreign coins circulating, in gold or silver, according to a resolution passed by Congress with Philadelphia. Well, this was called Continental currency, issued by the Continental Congress, and it deflated in value so rapidly that it coined the famous phrase, not worth a continental. Here's a continental dollar from 1776, which was the first ever coin made by the originally formed United States 13 colonies. This is today a major collector's item that's worth hundreds of thousands of dollars. But the fact of the matter is that we had hyperinflation, and the continental currency deflated in value from 1776 until 1789 by 99%. That's right, 99% drop. The official conversion rate when we went to the new federal system was 1 cent to the dollar. Now, Thomas Jefferson weighed in on all this in 1791. Now, what's critical about this date, 1991, is that this is the date just prior to inaugurating our federal coinage. So Thomas Jefferson has the following quote, which I'm going to read over the next few slides. I believe that banking institutions are more dangerous to our liberties than standing armies. Already they have raised up the money aristocracy that has set the government at defiance. This issuing power should be taken from the banks and restored to the people, to whom it properly belongs. Hold on a second, my slides aren't working here. If the American people ever allow private banks to control the issue of currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children will wake up homeless on the continent their fathers conquered. I hope we shall crush in its birth the aristocracy of the money corporations which already dare to challenge their government to a trial of strength and bid defiance to the laws of their country. Now, what you just read was a debate going on between our founding fathers as to what should constitute the definition of money. You see, the founding fathers just had their first taste with hyperinflation. Our first currency did not work, and it deflated in value so much that from 1776, when it was inaugurated, when our country was founded, until 1791, again, it had deflated by 99% value. So the founding fathers were debating what to do about this. So they decided that in the U.S. Constitution, which was just then being put together, that only gold and silver should be allowed as money. That's right, the U.S. Constitution strictly says that only gold and silver are money, not paper, only gold and silver. To that end, the first federal coin was created in 1792. This little coin you're looking at was created as history believes to have been produced from melted down silverware of Martha Washington. That may actually be her image on it too. We don't know for certain. But this great coin is worth over $1 million just by sidebar note. But that was our first federal coin. A small coin was called a half Disney, or equivalent in value to 5 cents back in 1792. This is how our country got started, with gold and silver as money. You see, we used to have real money. Now let's take a look at this $20 bill, which looks vaguely familiar to the one that you have in your wallet, but there's some big differences. Let's look at this. I'm reading from top to bottom. It says, this certifies that there has been deposited in the Treasury of the United States of America $20 in gold coin payable to the bearer on demand. So this reads like a bearer bond or certificate. You see, this is a certificate saying that the United States Treasury has $20 in gold that's set aside for the bearer of this $20 bill. Let's look at what our current $20 bill looks like. Well, as you can see, the United States of America is not on the top line any longer. It's now called a Federal Reserve note. And what the heck is a Federal Reserve note? And you see there's no, it doesn't say what this is good for anywhere. It doesn't say this is real money or it's redeemable for anything. It's a piece of paper. So we now have play money. We don't have real money anymore. Well, the most important date in U.S. financial history, if not world financial history, was 1933. This is an extremely important date in financial history of the United States because all the other nations in the world followed our lead. So really we can say it's the most important date in world financial history because it's the date when the United States declared bankruptcy. Now, if that sounds pretty strong, I want to quote from a speech given before our United States House of Representatives by a member of Congress, and he says at a speech that the United States declared bankruptcy in 1933, and that we are presiding over the largest reorganization in world history, and that the receivers of the United States is the Federal Reserve System. Now, in this speech, the congressman states that Federal Reserve note is not money. It's merely a piece of paper, and that only the U.S. Congress, I'm sorry, that the U.S. Constitution specifically authorized that only lawful money can be issued of gold and silver. So when 1933 took place, we declared bankruptcy. Now, what happened exactly in 1933? Well, Franklin Roosevelt, in a desperate bid to end the Great Depression, did the unthinkable, and he made it illegal for Americans to own their own money. And he put forth an executive order that stated that all persons are required to deliver on or before May 1st, 1933, all gold coins, gold bullion, and gold certificates now owned by them to a Federal Reserve Bank. Very interesting. So the Federal Reserve would now be the new owner of all this gold, and he made it a penalty of up to 5 years in prison or a $10,000 fine if you failed to do this. This executive order was followed up with by other executive orders, including a...
Excuse me, Greg?
Yes.
Actually, that was 10 years in prison.
Oh, 10 years, okay.
Or a $10,000 fine. And that $10,000 fine in today's dollars would be the equivalent of about a $500,000 fine.
So a very significant fine, to say the least. Now, this executive order was followed up with further executive orders that expanded upon the decision that Roosevelt made, and that it was finally culminated with an act of Congress that officially took us off the gold standard, where Congress quoted and said that gold and silver is now no longer allowed as currency of the United States, completely abrogating the Constitution and the rules set in place by our founding fathers in 1792. So here we have the U.S. declaring bankruptcy as a result because gold and silver is no longer money, and we're now going on a new play money system that's called the Federal Reserve note. Now the Federal Reserve we'll talk about more later, but the very interesting thing about this executive order was that rare gold coins were exempt. Anything of numismatic value, it specifically says in the order, of collector value was exempt to the order. So if you own rare coins, you were exempt from the order. Now, only Congress has the constitutional power to create money. That power has never been delegated to anyone else, but we do have a situation where that has been delegated because the Federal Reserve now creates our money. As you saw earlier, the United States of America is not the issuer of the currency, the Federal Reserve is. So where does its authority come from? Well, it doesn't come from the Constitution. It has come from a usurping of our law through acts that took place starting at the time of Roosevelt. Very few people pay any attention to this, but they're going to when they see what's coming. Now, what does the United States Treasury have to say about these Federal Reserve notes as opposed to the earlier United States notes? Well, it says the following. This is directly from the U.S. Treasury website. It says Federal Reserve notes are not redeemable in gold, silver, or any other commodity and receive no backing by anything. This has been the case since 1933. So the U.S. government is not trying to hide the fact of what's happened. They readily recognize on the Treasury website that in 1933 this is a defining moment in history where we no longer had real money. So it says by another sense that Federal Reserve notes are backed by the goods and services economy. They're backed by that, but they're not legal money. The U.S. Constitution says that only gold and silver is legal money, and there is no power given by Congress, except by Congress, to coin money. So the Federal Reserve is not a constitutional entity. We have been running for the last approximately 80 years in an unconstitutional system, and it's going to bite us in the butt big time coming down the road. Now, what does the head of the Federal Reserve have to say about his Federal Reserve note? Well, he says the U.S. government has a technology called a printing press that allows it to produce as many U.S. dollars as it wishes at essentially no cost. Again, there's no hiding the fact that this is nothing more than play money. Now, the second most important date in U.S. financial history after 1933 is 1971. So, what happened in 1971? Well, in 1971, we went off the gold standard as far as the rest of the world goes. You see, we went off the gold standard as far as private citizens were concerned in 1933. However, the United States still maintained the gold standard with the rest of the world. Now, what happened was that in 1944, an international agreement was struck in Bretton Woods, New Hampshire, one of the most famous dates in history, where the United States was set up to be the preeminent world reserve currency. So this took place and allowed the United States to maintain its position with the dollar to be considered as good as gold and convertible to all foreign central banks at the rate of $35 for 1 ounce of gold. Now, American citizens were not allowed to own gold. From 1933 on, American citizens were not allowed to own gold. However, the U.S. did allow foreign banks to collect any obligations that were owed by the United States Treasury at the rate of $35 for each ounce of gold. So huge amounts of gold started draining out of the Treasury as foreign governments demanded that they get paid in gold. I've been in Europe for quite a lengthy time now and have been wondering why there is so much gold in certain places, American gold coins in certain European nations like France. Well, the reason is that France was one of the largest countries, one of the countries that was the biggest voices demanding that they get repaid in gold, and they continued to do that until it all ended in 1971 when President Nixon declared insolvency by the United States and refused to pay out our debts any longer in gold and closed the convertibility of the dollar to gold. Now, this was a defining moment in American history when the dollar convertibility ended under Nixon. But what replaced it after that? Well, the money supply exploded after that. The money supply means how much money the government is printing. You see, with no constraints whatsoever as to what the dollar had to be backed by. If you recall, the early money required backing in gold, and it said that it was a certificate saying there was that amount of gold on deposit in the Treasury. Well, now that the dollar is nothing more than monopoly money, there's nothing to stop the government from printing it, and they sure have printed it like crazy. As you can see from this chart with the black line here, that the money supply has just been exploding over the years. The next way that the government tried to deal with coming up with a way of maintaining its status as the world reserve currency was through the petrodollar. This new system was devised which allowed the U.S. to operate the printing presses for the world reserve currency with no restraints placed on it, not even a pretense of gold convertibility whatsoever, through the invention of the petrodollar. So now it was agreed that oil would be priced in dollars worldwide for all transactions. This gave the dollar a special place among world currencies and in essence backed the dollar with oil. In return, the United States promised to protect the various oil-rich nations of the Middle East, and we all know what's happened as a result of that. And this allowed for a new system that was post the gold system with the oil dollar. So we called that the petrodollar, and this system was clearly less stable than the gold standard, but it allowed us to continue to operate the printing presses without too much people complaining. So the printing presses are operating at full speed, continuing to increase our national debt, continuing to increase the amount of dollars in circulation, and this resulted in tremendous inflation in the 70s and 80s. You see, the definition of a world reserve currency is the currency where all commodities are priced within that currency, and it's the one by which virtually all major transactions in the world have to go through first. So if you want to buy oil, you want to buy gold, you want to buy other commodities, you have to first change your dollars or your pounds or your German marks or whatever currency you have into dollars first before you can then buy the commodity you want to. The United States has been able to maintain the dollar as the world reserve currency for all these decades despite what we've been doing. Now, this hasn't gone without notice, the rapidly increasing United States debt, and the Chinese premier has been calling for an end of the U.S. world reserve currency status, proposing various alternatives. Now, why is the Chinese premier calling for this? Because the Chinese government is the largest holder of our obligations anywhere in the world. They hold approximately 1/4 of our entire national debt. The Chinese have sold us billions of dollars worth of goods, and we had paid for it on credit, and now they're sitting on over $2 trillion worth of paper dollars, and they're scared that those paper dollars are going to become worthless. So frightened are they that Timothy Geithner, the Secretary of the Treasury, has actually traveled to China at least twice to reassure the Chinese leadership that our dollar is still good as gold. One of the trips he made there, he was actually laughed down during his speech on this subject as to the soundness of the dollar. So you can see that the Chinese don't believe that our dollar is good as gold, and they want a new reserve currency. You see, what is stopping us from this happening? You're looking at a $100 trillion note from Zimbabwe, where only a few years ago the currency was $1. So $1 bought you a loaf of bread a few years ago in Zimbabwe. Now it takes $100 trillion to buy a loaf of bread there. Zimbabwe had a 2 million% inflation rate. And Zimbabwe just printed money like the United States does. So how come Zimbabwe had this enormous inflation rate and the United States hasn't had it? Well, it's very simple. Zimbabwe is not the world reserve currency, but the United States is. So because the United States holds this unique position as the world reserve currency, the rest of the world has allowed us to get away with printing enormous quantities of dollars that are backed by nothing. And at some point, these chickens are going to come home to roost, and the dollar is going to go bust. We cannot maintain the world reserve status for very much longer. When it's going to end, no one knows for certain. But if you Google United States world reserve currency, you'll see plenty of articles in the Wall Street Journal and other places about the concern about the United States dollar being replaced as the world reserve currency in the not too distant future. Now, when that happens, then we will experience enormous hyperinflation, because without the safety net of the world reserve currency surrounding the United States dollar, the dollar is as worthless as a piece of toilet paper and will quickly hyperinflate to the point you'll be carrying around $100 trillion notes in your pocket also to go out and buy a loaf of bread. Hyperinflation is coming to a country near you. The United States is not alone in what has happened in the past. Back during the early years of the country, and what is going to be coming in the very near distant future. As a matter of fact, 10% of the world's countries have experienced hyperinflation already. One of the most famous one is Germany, which experienced the value of its mark going from 1 mark at 1919 up to 1 billion marks in 1923 for the same buying power. So when I toured Berlin not that long ago, the tour guide said that toilet paper was more valuable than paper money during the 1920s, and frequently currency was used as a replacement for such. Very interesting. Now, many people might remember the Reagan Revolution. I remember quite well because I was a campaign worker for Ronald Reagan when he ran for president. You see, I believed Reagan's campaign promise when he was stumping on the premise that the United States cannot continue to spend more than it's taking in. He ran these elaborate campaign ads and speeches that showed the nation's ballooning deficits and national debt and said we cannot continue to do this. So a wave of voter panic swept Reagan into office, and that wave of voter panic we call the Reagan Revolution. Well, what was all this concern over? Well, a $900 billion national debt was what was at stake when Reagan became president. This was the huge amount of debt that he was afraid would cause the United States to collapse if it wasn't brought under control. Well, Reagan may have been a great president, but he unfortunately did not solve this problem. And today we stand bearing down on $22 trillion as a national debt by the end of the decade. Here you can see a chart showing the year-to-year budget deficits since Reagan took office, and the deficit just for the year we're in right now, 2010, will be double the entire national debt of 1980. So let me say that one more time. In 1980, our national debt was $900 billion. That was the total amount the country owed. This year alone, in 2010, we will add an additional $1.8 trillion to that national debt, and we're not even having a banking crisis this year. Now, this is on top of the $1.8 trillion deficit we had last year. That's right, 2 years back to back, 2009, 2010, $1.8 trillion deficit. So in 2 years, we've got $3.6 trillion added to our national debt. Now, what does all this money add up to? Well, it adds up to...
Excuse me, Greg?
Yeah.
You know, sometimes I find that people get the deficit and the debt mixed up. So, you know, if we can just clarify, the debt is the accumulation of all the deficits that we've had each year that weren't covered. In other words, anytime our expenditures are greater than the revenues, the tax revenues and so on that come in, there's a deficit that year. And lately there have been very, very few years that there hasn't been a deficit. So each year those deficits get added to the debt. So sometimes people interchange those two and get them mixed up, but the deficit is what we're looking at there, and that's being added to the overall national debt.
So my point is what happened to the Reagan Revolution? Did everybody elect Reagan and then go back to sleep and just complacently think, well, we solved that one, now we don't have to worry anymore? I mean, what happened? That voter panic was concerned over a total national debt of not even $1 trillion, and today we spend more than that in a single year. What happened? Did the national debt become meaningless all of a sudden? We have reached a situation in this country where the level of complacency is so high that it will take nothing short than a complete and total collapse to wake people up. I'm sorry to have to say that, folks, but the average person is so dense about what is going on right now that until we have a complete collapse, they're not going to wake up to what's going on. So as this chart shows, 22 trillion is the national debt by the end of the decade. Now, who came up with this number? Well, the government did. The Congressional Budget Office, which is assembled by our congressional leaders, estimate the national debt each year, and that's what they've estimated at. And that adds up to a total of $250,000 for every family of four in the United States. Now, that's clearly an unrepayable number. The average family of four does not have $250,000. So what is going to happen? Well, here's what's going to happen. The Congressional Budget Office recently forecast, and this is a direct quote from them, the debt level will soon reach 82%. I'm sorry, the debt level will reach 82% of the entire economy by 2019, threatening U.S. financial stability. Well, clearly, we can't have a debt equaling 82% of the entire economy. That's just an impossible situation. So what will happen is we will have to experience we'll have to have hyperinflation by 2019 in order to solve this. So when I'm telling you that hyperinflation is coming, I'm only simply repeating what our government is telling us. John Bonner is the senior Republican in the House of Representatives. He's the Republican leader of the House of Representatives. And he said, how many alarm bells have to be set off before Washington Democrats get serious about tackling dangerous budget deficits? And all due respect, the Republicans did create a lot of this in years past, but we all knew that when the Democrats got in power, they were going to put the pedal to the metal and really accelerate the spending, and that's what's going on now. Judd Gregg, who is the senior Republican in the Senate Budget Committee, said this is clearly a scenario where the country is going to go bankrupt. And those might have, you might sit there and say, well, those were all Republicans that said that. Peter Orszag is the senior Democratic official of the White House Budget Director, White House Budget Office that manages our budget. So he's in the Obama administration, senior member, and he says we are on an utterly unsustainable fiscal course. So these quotes that were taken from the Wall Street Journal in the past few weeks clearly show us that our government is stating that we've got a big problem here, folks. But are we going to do anything about it? Probably not. The sad reality is that there is no political will to do anything about this, and the people don't really want a government to live within its means. Sadly, the typical American wants his cake and eat it too, and is just not ready for austerity. If you go back 100 years in history, you'll see that we had a White House that had faulty plumbing, leaks from the roof, and so bad that sometimes the president couldn't even sleep in it. And we didn't have the money to fix up the White House. Today, when Obama came into office, he was given a multi-million-dollar budget just to redecorate his office. Now, where did all this money suddenly come from? It's very simple. In years gone past, the government was required to live within its means because we were on the gold standard. There was no flexibility to live without our means, live outside our means. Today, we can do anything we want to because, as Ben says, who's head of the Federal Reserve, the United States government has a printing press and it can print as much as it wants to. So we all have grown up to live in a society that says, I want it all. I want that new recreation center to be built by the government. I want them to fix the roads. I want them to give me unemployment benefits. I want this, I want that, I want the other thing. And as a result, the government has just turned into a giant cash dispensing machine for Americans that are all in the dole. This is what's taken place. So the people do not want to live with their means. In current year, 2010, we will have tax collections of $2.6 trillion, but we will have a budget of almost $4 trillion. So we are outspending how much is coming in by nearly 2 to 1. This is why the senior Democrats said we are clearly on an unsustainable fiscal course. But is there any political will to stop this? I don't think so. I think that the only way this is going to end is in a complete crash of the dollar. And I wish that wasn't the case, but there is no one on the political scene today who is sounding the warning bell in a big way. The president sure isn't saying anything about it. His cabinet may be saying things about it, but the top leadership of the nation is turning the other way and is not doing anything about this. Gold is the only true money. And if you've been listening tonight, you'll know that that was the case as to how our country was founded back in the beginning. The founding fathers recognized that their experiment with paper money did not work. So we've already had the experiment with paper money backed by nothing. The first currency of the United States of America was paper money backed by nothing in 1776, and it deflated in value to the point it was worthless. So we've had that experiment. We saw it didn't work. The founding fathers said, wait a minute, okay, we're not going to do that again. So gold will be the only lawful money, and we're going to put it in the U.S. Constitution. So what happened? Franklin Roosevelt obliterated our Constitution, and we've been living with deflation or inflation ever since. This is what's happened to our dollar since 1933 when it was taken off the gold standard. It's deteriorated to practically nothing. So prepare for the inevitable because hyperinflation is coming. That's it, Tom. Back to you.
Okay, thank you. I had just sent a note to everyone to go ahead and start typing your questions in. I'm sure that this will generate some questions, so if you have questions, go ahead. Let me just make mention while you're doing that. If you have questions, type them in the same area where you typed your name at the beginning. It's one of the reasons why we have people do this. We know that everyone knows where to put their questions in. But let me just go ahead and announce upcoming on May 31st, which is Memorial Day, we will not be doing a webinar. July 5th is not actually Independence Day as it says there, but it's the day after, and I know a lot of people will be out of town and celebrating because the Sunday is actually the 4th of July, and I'm supposed to be down in Haiti on that weekend dedicating a church, so I will not be around, so we're going to go ahead and suspend on that day, and then also looking ahead to September 6th, that is Labor Day. So those would be the 3 holidays that we'll be taking as far as the webinars. Okay, we have a question from David. He says, so is it a good idea to buy gold in order to hedge against this hyperinflation? Correct?
Well, that is the only way to protect yourself against hyperinflation because gold is the only true money. Gold has maintained its buying power since the beginning of the United States history. This is a piece of gold when the United States first was formed was considered, when the U.S. Constitution was formed, it actually spelled out not only that gold was money, but it spelled out exactly how much gold was money. It stated that $20 equals 1 ounce of gold. In other words, 1 ounce of gold would be $20. That's how the Constitution spelled out what money was. And today, that 1 ounce of gold will still buy the same thing it did 10 years ago, 50 years ago, 100 years ago, 200 years ago. So the buying power of gold does not change, but the buying power of the first piece of paper does change.
Okay. We have another question. Should I dump my silver bullion for gold bullion?
No, because silver and gold are both money. The U.S. Constitution deemed that gold would be $20 per ounce of gold, and that silver would be approximately $1.25 per ounce. So silver and gold are both money, and there's no reason to dump one for the other.
Okay. What about land? How does purchasing land compare to gold?
Well, as you heard me talk at the beginning of the seminar, real estate is certainly one of the bedrock assets of the United States, and that asset has gotten completely twisted and distorted by 2 decades worth of rampant lending that has totally distorted the value of it. Had we not had S&Ls and crazy banks in the last 5 years that we lived through that were running rampant with 100 to 125% loans, and instead all real estate was bought on a cash basis, then real estate would be in a sound footing and fundamentally poised to move up tremendously in value as hyperinflation begins. But real estate has got to get all this excess leverage worked out of the system before will resume its upward path. And no one really knows how long that will take, because the banks are still not done blowing out all of their loans and reorganizing themselves. It could still be a few years yet, just like it took time for the RTC to dump its portfolio. When it was finally done selling off its portfolio, then real estate reached equilibrium in terms of market value and then began to rise again. So real estate will again be a great investment and will certainly go up in value as the situation gets rectified.
Okay. What do you suggest we, the people, do to protect ourselves?
Well, as I've been talking, the best way to protect yourself is to buy gold. And I'd like to say that we could just hold a rally and do something about this politically, but the Tea Party group is getting all sorts of press at the moment, but they still are not hitting on the core issue. They're talking about we need to lower taxes, and that may be a great political soundbite, but that's not going to solve the problem. We have a problem where our government is chronically overspending what's coming in, and there is, as I mentioned, no political will to stop that. There might be political will to start a new group called the Tea Party to cut down taxes, because everybody's for that. But how many people are in favor of cutting back on government spending and bringing things into control, and which means personally suffering by not so much government waste taking place? Unfortunately, very few people are in favor of that. That's why I believe that it's going to take a crash of the dollar to get people's attention.
Okay. If one chooses to hedge inflation risk with gold, are gold coins the same as gold bars?
Probably you ought to tune into the webinar that I'm going to do tomorrow night at 6 p.m. Eastern Standard Time, and I can explain that in greater detail, because that's not something that I can answer in a few moments. But there is a difference between the two, suffice it to say, and on my other seminars I go into great detail to explain that. Ultimately, if you have money in a bank account, the people who lose in hyperinflation are people on fixed incomes and those who have their savings in a bank account, because those will get wiped out. People who live paycheck to paycheck are not really going to be affected by this too much, because their paycheck will probably be indexed for inflation. So the amount of income they receive every week will still probably be equal to the buying power of it, so they're not really that affected. It's the people who've worked their whole lives and set up a nice little a safety nut in a savings account paying 2% a year that are going to see the savings get wiped out.
Okay. By the way, I made myself presenter again so I could put up a keeping in touch screen. This got two things on it. One is an email address, webinars@bellsouth.net. If you're just visiting tonight or watching with someone else and you'd like to be notified of these Monday night webinars, which are held every Monday night at Eastern Time, 8 o'clock, you can send an email to that. Also, that's the only address to write to for replays of the webinars. A lot of times people write to other email addresses, and sometimes it can take weeks to get the links sent to them. So please only write to webinars@bellsouth.net. But also, if you'd like to hear Greg's webinar tomorrow night and you're not already on the list for that, he does webinars at 6 o'clock every Tuesday night. The reason it's at 6 o'clock rather than a more normal webinar time of 8 o'clock for the States is that Greg is in Europe, and so he's actually, it's 3 o'clock in the morning for him right now, which is why he doesn't normally speak on our calls. But he does his own conference calls at 6 o'clock on Tuesday nights. If you write to that address, I'll make sure that you get on his list and get an invitation for that webinar. I'm just going to read a couple of questions that would be better answered in that forum because we are running short on time. And I'll just read the questions out, and Greg will answer those tomorrow night. And as you know, buying gold in what forms? That's something that would be a good question for tomorrow night when he would have more time. Bob asked, is it smart to pull pre-1982 pennies for copper value, or is that a waste of money? It has doubled in value in a year. What's the safest way to hold gold? These are questions that are better suited towards tomorrow nights. Let me give Greg just a little break and answer a question that I'm qualified to answer, which is Robert's question. For those of you that don't know, I've been in the investment business as a stockbroker, branch manager, financial planner, investment banker, and so on for the last 35 years. He asked about how about buying the ETF GLD. Two problems with that, Robert. One is that the GLD doesn't actually hold bullion, although most people assume that's the case. So if there was ever a meltdown, they would not have the bullion that to cover all the holdings. But an even bigger problem with any paper form of holding gold is that the main reason why we're buying gold is, well, there's really two reasons. You buy bullion gold to hedge against inflation, and you buy investment-grade gold, which is the coins, particularly the rare coins, for appreciation. But if you're buying bullion to hedge yourself against inflation, you want to hold the physical gold. Any paper form of gold will not do the trick, whether it's a gold certificate, these e-golds you can do online, even holding gold, say at the Perth Mint or some of the other national mints around the world, because you're holding the gold denominated in dollars or whether even in euros. The problem there is, as the value of the gold goes up, the value of the currency you're holding it in goes down, and so when you sell it, you've often lost a lot of the value that you gained. It's kind of like walking up and down an escalator. You can do it, but as you move it up, the stairs are going down. So if you're buying gold as a hedge, then you definitely want to do it and hold the yellow stuff. Larry from Iowa asked a good question. What can we do to escape the government's power to recall all gold coins, even rare coins?
Well, as you noticed, that back in 1933, rare gold coins were exempted. So that represents the most draconian act in U.S. history, and they were exempted then. So I see the reason why the government did that in 1933 was that was a necessary step to get us off the gold standard. Today we're already off the gold standard, so there's really no reason for the government to come in and be looking around for your rare gold coins. So I do not see that as a threat.
Yeah, there's another aspect to it. Actually, one of our people that's on the line tonight, Dwight, brought this up very eloquently in a conversation with me recently. He referred to it as a hassle factor. You know, we were actually talking about IRAs, and but in the conversation, we got around to the fact that the government had exempted the what they called numismatic gold. You know, anything that's graded as collectible value in 1933, and the fact that there's no guarantee that they would do that, say if Obama decided to do a confiscation again. But everyone that is an expert on this subject feels that they would. And as I say, Dwight expressed it well when he talked about the hassle factor. If you think about it, back in 1933, it was very easy for the government to say, okay, give me your $20 gold coin, and we're going to give you this $20 Federal Reserve note. Never mind that the Federal Reserve note wasn't really worth $20. It said $20 on it. People had gotten used to it. They started issuing them 10 years prior, I believe, you know, very with conscious intent to get people used to the new notes. They were circulated side by side with the real money for 10 years. And so it was an easy thing to determine the value. Your $20 gold coin, here's a $20 Federal Reserve note. If they had tried to confiscate the numismatic coins, then there would have been a question of value. Well, it's not just the gold value. This has rarity value. This has numismatic value. And so there would have been a lot of back and forth, a lot of testimony from experts, court cases, and so on. And there are so many more times, hundreds, thousands more bullion coins that are rare coins. For the small amount of good it would have done the government comparatively, it just wasn't worth the hassle. So the presumption is that the same would obtain if Obama did a confiscation again. It really wouldn't be worth their while for all the hassle. It'd be much simpler just to grab all the easy gold and the low-hanging fruit.
Yeah, I agree with that. I just don't see this. I don't see rare coins being confiscated as being an issue.
Okay. We got time for one more question. Mike says, let's say you're correct. What other currency would you think is the most stable?
There are none. The problem that exists with the United States is an epidemic around the world. The United States has clearly overextended itself beyond any imaginable amount possible, but it has not alone. Great Britain has done this. The European nations are doing it with the euro. So all central banks in the world are printing money that is backed by nothing, and there's no safety in any currency.
Yeah, let me just add to that, Greg. I did a webinar on the Monday night a few weeks ago, and it's archived if anybody wants to refer to it. But I talked about that very subject, and I used as a reference point something called the Global Gold Index, the GGI. And what it does is it compares the various different currencies to gold as a standard rather than the way currency traders do, comparing one currency to another. For instance, the U.S. dollar, since the euro was issued as a currency in 2000, has been dropping relative to the euro, and then more recently the euro's been dropping relative to the U.S. dollar because of all the credit problems they've been having in Europe. This masks the fact that both of those currencies are in terrible condition, and you can see that it's artificial because of the fact that at the same time that very recently gold was hitting a high against the euro. It was dropping against the U.S. dollar. So what the Global Gold Index does is it takes a basket of the 10 biggest currencies in the world, including the dollar, the euro, the pound, the yen, and so on, and it creates an index, and then it measures those currencies not against one another. It amalgamates them and measures them against gold. And on that standard, this whole basket of currencies that represent 2/3 of the GDP of the entire world have lost 75% of their value just in the last 10 years. And that leads us into our last comment. Greg Gary from Canada, our host, normally on these calls, says that he just heard from a significant source that the U.S. dollar will reduce in value 30 to 50% in the next 9 months, and because Canada relies heavily on U.S. trade, it will also be dramatically affected. Any comments on that, Greg?
Well, I have noticed that the Canadian dollar has risen to parity with the U.S. dollar, and for years the Canadian dollar was only worth 60 to 70 cents, and has recently risen to parity. So Canada does not have near the debt burden that the United States has, and has not been anywhere nearly as badly mismanaged as the U.S., and that's the reason why its currency has risen. But how Canada would be affected in the event of a dollar hyperinflation, I don't know. Nobody really knows what the effect will be with the dollar hyperinflation, other than the obvious that common commodities will be far more expensive in dollars. And one thing you have to remember is that the price of a loaf of bread or a new car or a new house doesn't go up. It's the value of the piece of paper that is deteriorating. Just like with our first currency we ever printed, that first experiment with paper money went bust, and that's why the Constitution was written to address this issue. Our founding fathers wrote a Constitution to protect ourselves from future leaders that might try to rewrite the laws of America. But somehow our leaders managed to rewrite it without Americans objecting. So why there hasn't been a revolt simply goes to the heart of this matter, and that is that we all are looking, well, I shouldn't say all, but most Americans are looking for a free lunch, and that's why there's been no revolt over us going off the constitutional mandate of gold being money.
And as we wrap up, Greg made the statement earlier that silver and gold are the only money authorized in the Constitution. While he was talking, I went to conservativetruth.com, where we have a copy of the Constitution, and I did a word search for gold, silver, money, and coin. And you can do the same thing. If we had time, I would actually take you there and show you the search. But look up those 4 words, go through the entire Constitution, and you won't find any place in the Constitution where money is referred to in any other way except as coin or gold or silver. In other words, when the Constitution talks about issuing money, it talks about coining money or issuing coin. So the whole idea of paper money is, as Greg said, it's unconstitutional.
And the reason, again, for that is because our experiment with that in the United States failed. And that's why Thomas Jefferson gave the speech that we read earlier in the debate about informing our Constitution as to why we needed to set up gold and silver as money and not paper.
It's not that paper itself is evil, as long as the paper is backed by something, which it was until 1933. But as long as you could take that paper, say you didn't have to carry around pockets full of gold coins, as long as you could take that paper and turn it in and get gold for it, whatever you wanted to, then it was real money. But when they turned it into just an IOU, which is what you have in your pocket right now, it's not real money. If you examine it closely, you'll see there's nothing on it that indicates that it is real money. It's basically an IOU from a private corporation that is not a federal government organization. And, of course, that's beyond the scope of our conversation tonight, and we are running a little bit late, but there are other webinars. There's a lot of articles on this. If you're interested in learning more about the Federal Reserve and the fact that it is not a federal organization, I'd be glad to send you links to articles on that. Greg, any closing thoughts?
Well, thank you all for listening, and if you'd like to learn more about this subject, listen in on the seminars we do on Tuesday night at 6 p.m. Tom can explain to you how to do that.
Okay, well, it's on your... I'm sorry, go ahead.
Yeah, thank you all for listening.
Okay, it's on your screen, webinars at bellsouth.net. If you'd like to register to attend the webinar tomorrow night. David says, what was that website again? It's conservativetruth.com, conservative truth. It's either .com or .org, either one. And it's as it would sound like, it's a conservative thought. There's a lot of articles on there about these types of subjects. Greg has written extensively for the website. And also at the bottom of your screen, ChristianFinancialConcepts.com, a lot of our webinars are archived there. And you're welcome to go there and see those. In the meantime, until they're all archived, you're welcome to write to webinars at bellsouth.net and request a list of the webinars that we've done here on the Monday nights. And yes, Chet, the webinar tomorrow night will be recorded, right, Greg? All the webinars are recorded, and there's also a list of those that's available. So with that, I appreciate everyone being here. We had a great turnout tonight. Appreciate you all being here. Good night, and God bless you.